This is the Chappell Real Estate Show, Season 2, Episode 2.
Welcome to the Chappell Real Estate Show, your source for the latest real estate information so you can buy, sell, and invest with the best in Texas. Whether you're a first-time buyer, a current homeowner, or a seasoned investor, you've come to the right place. We're here to simplify all things real estate so you can achieve your goals of property ownership with your hosts, Daniel and Roger Chappell.
What's up, listeners, and thank you guys for tuning into the Chappell Real Estate Show, your source for the latest real estate information so that you can learn how to buy, sell, and invest with the best in Texas. I'm your host, Daniel Chappell, and today we're recording just one day after the incredible 2/22/22, and it's only appropriate that this be Season 2, Episode 2 of the Chappell Real Estate Show. So today we're going to be talking about what you can qualify for when it comes to buy a home. So if you've been following our show for a long time, then you have probably heard some of our previous episodes, and we have absolutely touched on this topic before. But today's market is a little bit different, and there's a lot of dynamics at play that are making a big difference in what your ability to qualify for a loan is. So today we're going to talk about some of those little nuances and details, and hopefully you'll get some information that is beneficial for you in your situation, or maybe you know somebody who this might be able to benefit. So keep that in mind. Think of somebody who you might be able to share this episode with as we progress through the details, and let's jump right into it, guys. Okay, so it's no secret that the real estate market has become very, very saturated. And we have, very few homes for sale, and there's still a ton of buyers in the market, especially in the market that we work in with the Chappell Realty Group, which is the Central Texas, Austin market, a little bit into the Houston area, as well as some parts of San Antonio. So, we really have a pretty big snapshot of what's happening in the Central Texas area. And, what we're seeing down here is happening in a lot of places all across the country. So whether you're in the Central Texas area or not, the information that we're going to share here today may be somewhat applicable to what you're seeing in your own local market. But if you're considering moving to the Austin area, this is definitely going to be mostly relevant to our market area, as most of our episodes are. So as I mentioned, if you've listened to our episodes before in the past, then you've heard us talk about some of the tips and tricks for buyers as they enter the market. We've talked about what the Austin real estate market looks like, both on the buying and the selling side. So we have a lot of information out in our previous episodes about these topics. But today in particular is really about what it takes to qualify for a loan. So not only are we going to talk about some of the details of, what are the debt to income ratios required, and what are some of the things that your lender is going to look into as far as your credit history and your debt obligations, your assets and liabilities and things of that nature. But we're also going to talk about some of the outside factors that affect how much you can afford to pay for a home, because as we most likely have heard, if you've been interested in buying in the real estate market, or you own in the real estate market, then you probably have your finger on the pulse when it comes to interest rates, and you've heard that the Fed is looking at raising interest rates a little bit, and that is of course going to affect how much you can afford to buy a home for. So we'll talk about a little bit more in detail as far as what that means when an interest rate rises, and how much it affects your buying power when it comes time for you to actually purchase and qualify for a mortgage. So first of all, when you talk about how much you can afford to buy in the real estate market, there's a lot of factors that you have to look at. Number one, it obviously costs money for you to purchase a home. So we have to look at how much money do you have in the bank? Can you afford your down payment? Can you afford your closing costs? What kind of mortgage loan are you going to be getting? So there's FHA loans, there's conventional loans. If you're a veteran, you have the VA loan access. Depending on location, you may have access to USDA loans. So there's a lot of different loan programs that are going to affect how much your down payment is going to be. So we'll kind of talk about those first. So let's say FHA loans, there's programs anywhere between 0 and 3.5% down. Conventional loans, there's most typically 5 to 20% down for conventional loans. VA loans are typically going to be 0% down, but you can, of course, put a down payment on them. And then USDA loans are also going to fluctuate as far as the down payment is concerned. So there are, a few things to think about, but that's the first one is what is it going to cost me in a down payment? So simple numbers, right? If you're using a FHA loan, 3.5% down. If you're looking at a $300,000 house, you're looking at roughly $10,500 for your down payment portion. Now, remember, keep this in mind. Your down payment and your closing costs are two different things. So those are two separate budgets that you need to make sure that you're prepared to pay for when it comes time for you to purchase your home. So down payment, like I mentioned, at 3.5% on a $300,000 property, you're looking at about $10,500. On a conventional loan, if it's 5% down, then you're looking at maybe $15,000 for your down payment. If it's up to the 20% down payment, obviously the more money you put down, the less money you have to borrow, which equates to a lower mortgage rate. A lower mortgage payment and possibly a lower mortgage rate as well. Because with FHA loans and government-backed loans in particular, there's going to be an additional mortgage interest that you're going to have, mortgage insurance that you're going to have to pay that will increase your monthly payment. So, something to keep in mind. But using simple numbers again, anywhere between that 3.5 to 5 to 20% down, it's easy math. You just take the cost of the property, multiply it times that percentage, and that's how you're going to calculate the down payment that you're going to need. So that's number one, is down payment. Now, number two is going to be your closing costs. So closing costs are going to fluctuate based on a number of factors. Of course, whenever you get a mortgage loan, there's going to be fees associated with that. There's going to be title fees. There's going to be loan origination fees. There's going to be document preparation fees. There's all kinds of fees that go into your closing costs. Your portion of the year's taxes. So if you purchase a home halfway through the year, let's say you purchase it on June 30th, well, the seller is responsible for the taxes up to the closing date, and then the date of closing onward, you're responsible for the taxes. So, that can play a big difference as well. If you purchase early on in the year, your portion of the tax bill is going to be much larger at closing, rather than if you were to purchase it say midway through December, you're only responsible for the last couple of weeks of the year's worth of taxes. So your down payment, or rather your closing costs, can fluctuate, but a good rule of thumb to be prepared for is 2 to 3% is what you're going to be paying for closing costs. So keep that in mind as well. So again, if we're using simple numbers, 2 to 3% of a $300,000 property is going to range anywhere between $6,000 and $9,000 additional dollars that you're going to need on top of the down payment amount. And in today's market, you can expect that you're most likely going to be paying for both of those, down payment and closing costs. At one time when, the market was a little bit more saturated with inventory and not so many buyers, you could maybe get away with asking for a seller to pay for some of those costs, to pay for a portion of your closing costs, or things of that nature. That's not so much the case in today's market because it's so competitive, inventory is limited, and there's a lot of buyers in the market. So I would expect to go ahead and calculate, if you're using a conventional loan, remember you're 5% down for your down payment, and then on top of that, 2 to 3% for your closing costs. So all in all, 7 to 8% is what you're looking at for your down payment and closing costs. So what the lender is going to be looking at is, one, they're going to be verifying that you have this set amount of money in order to be able to fulfill your responsibilities at the closing table and pay for your down payment and closing costs. So the lender is going to do a complete evaluation of all of your financials. So they're going to look at how much income do you have from your regular job? Do you have a side job or side hustle that earns you any additional income? How long have you been in those positions? They're going to verify your employment and make sure that it's long-term gainful employment. They're going to, if you earn commissions, they'll require a certain time period of commission statements so that they can validate and verify the consistency of those commissions and if that income is reliable income. They're going to look at any assets that you may have. So if you own other pieces of real estate, if you own businesses, if you own stocks and bonds and things of that nature, all of that is going to play into your ability to qualify for a loan. In addition to that, they're going to look at your liabilities. So they're going to look at how much credit card debt do you have? Do you have any additional mortgage loans? Maybe a car loan. Do you have any student loans? All of these things are going to play a factor into your debt to income ratio. So basically what every loan program has a slightly different number for the front and back end ratios of what they allow your debt to income ratio to go to. So when evaluating your debt to income ratio, the lender is going to look at what they call your front end ratio and your back end ratio. Your front end ratio is going to be the amount of your income that goes towards your liabilities before your mortgage payment is calculated into it. So again, I like to put numbers to it to kind of hopefully add a little bit of clarity. But let's say, for example, again, I like simple numbers. So let's say, for example, you have $10,000 a month in income and $2,000 a month goes towards your car payment, your credit payments, any additional student loans that you may be paying off. So if $2,000 of your income is going towards debts and you make $10,000, then that's 20% as your front end ratio when it comes to the lender's qualifications. Now your back end ratio is going to account for your potential mortgage payment. It's going to take that $2,000 a month that you're paying towards your liabilities, and then it's going to add your projected mortgage payment to that. So to give you a general rule of thumb, your front end ratio should typically be at or below somewhere around 25 to 28%. If it's any higher than that, then it's going to drastically reduce the amount that you're able to qualify for a mortgage payment. Now your back end ratio is, and keep in mind, these front end and back end ratios are subject to the loan program. So FHA loans, conventional loans, USDA, VA loans, all of these loans have different loan qualifications that you have to meet. So these front end and back end ratios that I'm giving you are not firm numbers. It depends on the loan program, your financial situation, your credit score can play into this as well. So keep all that stuff in mind. But your back end ratio is typically going to be somewhere around the 40 to 50% range. 50% being on the very, very high end of that. So again, for simple numbers, if you have $2,000 going towards your debt servicing and you are projected to have a $2,000 mortgage payment and you're making $10,000 a month, that would make that $2,000 plus $2,000 equals $4,000 out of $10,000. Means that you're at a 40% back end ratio. So keep all that stuff in mind. If you're in a position where the majority of the income that you make is paying out car loans, maybe you have another mortgage payment, maybe you have, child support, all those kinds of things play into your debt to income ratio. If you're exceeding that 30% before you're factoring a mortgage payment, then you've got to get some debt paid off before you're more than likely going to be able to qualify for a loan that's going to be able to get you a mortgage or to purchase a property. Okay, so to kind of quick recap, basically everything that we've covered up to this point is in order to qualify for a mortgage, you're going to have to have a lender review your financials to ensure that you're able to borrow for a mortgage payment. They're going to look into any liabilities that you have. They're going to look into your credit score. They're going to look into your employment. Something to keep in mind as you progress through the home buying process is understanding that there's a lot of factors that affect your ability to qualify for a loan and that affect how much you can qualify for a loan. So the most significant impact that's going to affect your ability to qualify for a certain loan amount is going to be your interest rate. Now, your interest rate is dependent on your credit worthiness. So if you have a poor credit score, your interest rate is going to be substantially higher versus if you have a really great credit score, you're going to qualify for some of the better interest rates. Interest rates are also affected by the length of time that your loan is. So a 15-year mortgage is going to qualify for a lower interest rate than a 30-year mortgage. Something else that's important is the Fed is currently discussing raising rates on short-term loans, which in turn eventually impact long-term rates. So it's likely that in the next 3 to 4 weeks, we're going to see some increases in mortgage rates. So an easy number to calculate how much a mortgage rate is going to affect your buying power, if the mortgage rate increases 1%, so if we go, or 0.1%, then that affects your ability to purchase by 1%. So if the mortgage rate goes from 3.4 to 3.5, your $300,000 is now going to be worth $297,000. Another simple way to calculate it is if the mortgage rate, it's likely that this first mortgage increase is going to be a pretty substantial one. So let's say, for example, we go from a 3.5 rate to a 4.5 rate. That 1% is going to affect your buying power by 10%. So if you're looking at a $300,000 mortgage and our rates go from 3.5 to 4.5, that $300,000 is now worth only $270,000. So keep that in mind. These numbers are very impactful. So when it comes to what you can afford for a mortgage payment, at the end of the day, it really is a conversation to be had between you and your mortgage lender, because there are so many factors that go into it, as we've already discussed, right? Your income, your credit worthiness, your liabilities that you have, any current mortgages that you might be paying, any car loans that you have, the current going interest rate. There's just so many things that go into how much you can afford. It's incredibly important that you have a good lender that you can work with. So that takes us into the end of our episode, where we talk about referrals. So driving it home again for my dad, Roger, who was unable to join us for the episode today. One of his famous lines at the end of almost every single one of our episodes is referrals. We run our business entirely by referral. We know some of the best professionals to partner you with when it comes to mortgage lenders, like what we're talking about today, or even if it's appraisers or inspectors, title companies, contractors, handymen, anything that you might possibly need. We know the people to connect you with. So be sure that you reach out to us if you're interested in finding out next steps. Definitely comment below and let us know what some of your questions are. We'd love to answer any of your questions. We're going to continue a series for buyers for this first portion of the year. So we're going to talk about some of the tips that you can use for buyers, what home buying looks like, kind of a home buying 101. So we're going to do a lot of these episodes, but we would love to hear what your questions are so that we can stay relevant, make sure that we're answering things that are pertaining to, you and your personal situation, because I can all but guarantee that if you're experiencing something, there's somebody out there who has the same question but hasn't found the right person to ask it to, or found the right resource to get them the right information. So please comment below, let us know what we can do to help you, and definitely continue to tune in and listen to the show. And again, referrals, and let it go both ways. Don't only reach out to us to let us know how we can help you. Do us the favor and share this episode with somebody who you think might benefit from it. We would love to talk to you and your friends and family and deliver more content for a wider audience. So please help us get this podcast out there. And again, thank you guys for tuning into the Chappell Real Estate Show. This is the Chappell Realty Group signing off. Take care.
Thank you for joining us this week on the Chappell Real Estate Show. If you enjoyed this episode, share it with a friend and leave us a review. Find us on social media at Chappell Realty Group and online at chappellrealtygroup.com. Until next time.